Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the Bank of Canada walks a fine line on interest rates as inflation cools and the labor market softens. And for all the effort around improving housing affordability, why are we getting so little traction? Plus, a standoff between government and tech about media, a fight that may be out of our hands but is hugely important to all of us. That's all ahead. First, for the week that was in business, it's time for the briefs. The central bank raised interest rates again this week to 5%, making borrowing the most expensive in 22 years. Tiff Macklem also said inflation may not be brought under control until mid-2025, 6 months longer than previously hoped. Strong consumer spending and surprisingly persistent labor market tightness are both factors. The bank said it intends to be sure it can beat inflation.
If we don't do enough now, we'll likely have to do even more later. But if we do too much, we risk making economic conditions unnecessarily painful for everybody. We've come a long way, and we don't want to squander the progress we've made. We need to stay the course to restore price stability for Canadians.
Prices in the U.S. did cool in June, with inflation there now running at 3%, including flat grocery prices. That should be good news, but economists in the U.S. worry the decline in prices off 20-year highs may have stalled out and that bringing the remaining inflation in line will be harder. Both wages and services prices are climbing south of the border. A Canadian watchdog into corporate malfeasance abroad has launched 2 separate investigations alleging use of forced Uyghur labor in their supply chains. Dynasty Gold Corporation and Nike Canada are said to have or have had supply chains in China that benefited from the exploitation of the minority group. CORE, or the Canadian Ombudsperson for Responsible Enterprise, has the power to investigate only and limited ability to penalize any wrongdoing. Both companies have denied the allegations. Canadian clothing retailer Aritzia is feeling the pain of inflationary pressures. The Vancouver-based company said its profit was down 43% from a year ago, despite double-digit increases in sales. Aritzia blamed higher costs and inventory management issues for the hit to the bottom line. Hollywood's largest actors union, SAG-AFTRA, joins the Writers Guild of America in a work stoppage. Issues include pay, residuals from streaming, and the use of artificial intelligence. It hits tens of thousands of Canadian jobs in film and TV production. And those are your business briefs. So did the Bank of Canada basically admit this week that it's worried about getting inflation under control? Well, it definitely signaled it will take longer than it previously thought to do it. Benjamin Tal is Deputy Chief Economist at CIBC Capital Markets. Thanks for being with us.
A pleasure. Thank you.
Were you surprised by the extension in the timeline? It's now mid-2025 before the bank sees inflation under control.
You know what? I think it was a brilliant move as far as the Bank of Canada is concerned. They're basically telling you, listen, we don't know. It might take longer. So they are buying time. In order to do so, you basically prevent yourself from making a monetary policy mistake and overshooting in a very significant way. Because you can say, okay, we have time, so we don't have to rush. Can you imagine a situation in which they say, listen, inflation should reach 2% in mid-2024. It's not happening, so you have to raise interest rates. And raise interest rates again, and you overshoot and you kill the economy. They bought themselves time and peace of mind, which is actually a brilliant move, quite frankly.
Ben, one of the key things about 2025 is we know because of the number of homes that were purchases and mortgages that were laid on, that 2025 is going to be a big year for resets. 2025 and 2026 are going to be big years because it's 5 years from when there was a big bulge. Can we anticipate that, therefore, rates are stable or even lower at that point? Is that what that suggests if the bank says inflation's under control by then?
Absolutely, and it's crucial that the interest rates will start falling in 2024 towards 2025. You're absolutely right. 2025, 2026, we need to see interest rates lower. Otherwise, the impact on the economy and mortgage holders will be very, very significant. The gap between the COVID days and those rates will be very significant. So we need to see rates going down. So the hope is that inflation will be under control by, let's say, late 2024, so interest rates can start going down in 2025.
One of the things that Tiff Macklem at the Bank of Canada made clear is that they're worried about wage expectations, wage demands being kind of sticky here, that people have gotten used to higher inflation and that we are seeing wages creeping higher and higher. How much of a concern is that in your view? Because we are seeing, current negotiations even in the double digits as people try to play catch up to inflation over time.
Yes, it's a bit of a concern. We have to remember that inflation was rising much faster than wages for the past 2 years. So now you're just catching up. It's not really more than that. I think that a lot of the tightness in the labor market is a bit of an illusion. It's a mirage because many of those vacancies will start disappearing. We don't see significant increase in wages in the low wage segment of the economy. So I think you will see the labor market not as tight as perceived, and that will help the Bank of Canada. And I think that they are hoping that will be the case. We have to remember one thing, Amanda, that's very important to remember, that the Bank of Canada is biased. If you wake up the governor of the Bank of Canada in the middle of the night and tell them, recession or inflation, they will take a recession any day. That's the reality.
Right.
So that's the reality. That's the situation. So for every good news, I can give you bad news, but they will put more weight on positive numbers because you prefer to overshoot than undershoot. Because overshooting, it's much easier to fix by just cutting interest rates.
Okay, so in other words, they would welcome a recession if that's the only way to get inflation down. At the moment, they're still saying, don't look for a bad recession. Do you think they're overly optimistic about that?
I think that if they stop now, or even stop in September, another 25 basis points, we are going to get what I call a wannabe recession, not a real recession. Maybe GDP growth will be negative, but the labor market will be fine. If you continue to raise interest rates to 6%, 6.5%, then you get an old-fashioned recession with blood in the labor market. And therefore, by saying that inflation will reach 2% by 2025, you're actually buying yourself time and preventing this kind of scenarios. That's why it's a good move.
So good to have you, Benjamin. Thanks for your time.
A pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist at CIBC. Still ahead when it comes to housing affordability, more supply is the obvious answer. So why is it so hard to build more housing?